Hey everyone, Jim Fitzpatrick. Welcome into another edition of Inside Automotive right here at CBTnews.com. As we close out of the third quarter, dealerships are navigating a changing market while preparing for the expiration of EV tax credits. So today we are joined by Kevin Tynan, who's the Director of Research at the Presidio Group, to break down what we saw in the last quarter and what these trends mean to the industry as a whole. So thank you so much, Kevin, for joining us once again on the show.
My pleasure, Jim.
Yeah, I hope you had a nice summer. Now we're heading into the holiday time, right, of the year, which is also a time when every manufacturer and dealer are trying to get out as many units as they possibly can. So let's start with the big picture. How does how did this third quarter shape up?
Actually, reasonably strong. I think what you got a lot of, Jim, was earlier in the year, there's this concern about tariffs. So
Yeah.
you had a volume pulled forward in March and April, and then a little hangover for the next couple of months. And then there was a pretty good surge in the summer and into the third quarter. And I think what happened is you have automakers really kind of absorbing the extra tariff costs.
Mm-hmm.
So you had this threat of higher prices and the consumer kind of getting out there and purchasing early, and then that push through of higher prices never really materialized, and that helped other buyers kind of get in early. So you could argue that there's a lot of the pent-up demand is gone from the industry, but the seasonally adjusted rate has held up. The other thing I would say is this: as we get into the fourth quarter, the comparisons get very difficult. You had last year in 2024, October was the first 16 million unit seasonally adjusted rate of the year, right? And we've had several. We've had 4 or 5 or 6 already in 2025. And then you had November at a 16.5 and December at a 16.8. So it even got more intense as the fourth quarter went on. I would find it very difficult to believe that with the way volume has been so far through the year with those couple of spikes in the spring and in the summer, that we would surpass a 16, a 16.5, and a 16.8 in the fourth quarter. So I think volume would be a little bit under pressure, or at least the headline volume numbers are going to be tough comparisons heading into the fourth quarter.
Yeah, for sure. And what are you seeing in terms of overall consumer demand? I mean, you touched on it a little bit, but will that remain at the same level it is now?
Yeah, and I think the key there becomes pricing, right? Discounts, incentives, and what net pricing winds up being. And I feel like there's a little bit of pressure there. So it's, when you think about the total revenue pool for the automakers and for the dealers, it's a play between volume and pricing, right? You can have great volume, but if you're giving away the store, it doesn't really matter.
Right.
Same thing in reverse, right? You could have low seasonally adjusted rates or unit sales with really strong pricing, and the net benefit is to the dealers and to the manufacturers because the revenue pool is bigger. I feel like we're at a little bit of a point where both of those metrics are under pressure. So I think volume is going to be a tough comparison in the fourth quarter, but we're also starting to see the consumer push back a little bit on pricing. The gap between MSRP and transaction prices getting wider. It's over $2,000 again, which is about 4%, and that's the highest it's been since before the pandemic. Since supply got really tight during the pandemic, it was very common for $2,500, $2,600 discounts before factory incentives. And we're not quite there yet, but it's pushing higher, which to me is a sign that it just costs more money to get the consumer off the sideline.
Yeah, for sure. Especially with the affordability still being at the forefront of everybody's minds, the consumers as well as the dealers and the OEMs for that matter. I mean, I don't know where, we've talked about it before for the last 5 years, where is this headed? We're going to, I think maybe in 2026, maybe it'll go over $50,000. I don't know, but it sure feels like we're there now, right? And the consumer is just, they can bend just so much before they just go, time out. I'm not buying a new car right now.
Right, and that's a very interesting point, because 8 of the last 10 months, the average MSRP, so the asking price, has been over $51,000. Now, I also saw an estimate by somebody that said once the manufacturers stop absorbing the tariff costs and push them down the line, it could add another $2,000. I think the number they gave was $2,300. So think about that. That means your average MSRP is over $53,000.
Yep.
The problem, Jim, is that I don't think there's the commensurate technology advance to warrant higher MSRPs, right? So what I mean is that what does the consumer get? And this is why they start to push back. What is the consumer getting for that $53,000?
Good
that's
point.
more than what they're getting at $48,000 or $49,000.
Right.
I think what was supposed to happen, we've talked about this a lot, it was supposed to be electrification.
Yeah.
The software and the drivetrain technology would say, if nothing else, hey, it's completely new and different, and the consumer could say, okay, at least I'm paying for this latest, greatest whiz-bang technology.
Right.
That didn't work, or it's not working so well so far, and the consumer hasn't really bought into that. And when you think about it, the time, effort, and money invested in that EV transition not going as well, in terms of adoption as was originally expected, there was no other investment in existing technologies, right? So where does it come from? Where does the consumer see that they're paying more for? Self-driving features, advanced safety? I'm not sure it warrants this $5,000 bump from 48 to 53 that the consumer says, I see it, I see what I'm paying for now. And I think this is going to be a problem for a little bit of a window, and it could be several model years.
Yeah, and I mean, we've already seen the average length or age of a vehicle on the road go from 10 to 11 to 12, and this is the reason. I mean, people are saying, unless you can give me, to your point, really good reasons, whether it be technology or otherwise, to make the move into a new vehicle, I'm going to hold on to what I'm driving. And they're making better cars, as we've talked about before, and it is concerning, to say the least.
Yeah, and in a weird way, I kind of feel like what is next, right? So does that mean that one way or another, with the sunk investment already, that automakers have to make electrification work? Because if not, where does it come from? What's the next thing? And I'm not sure, you're going to see U.S. automakers, Japanese automakers, and European automakers get together and leapfrog electrification and go right to hydrogen.
Right.
And I know that we can go back to internal combustion and drive prices higher, right? Can there be that much of a technology advance, or does it come just purely from software and subscriptions or whatever happens? But there has to be that catalyst that gets the consumer to pay more, and I think the industry is really lacking it right now.
Yeah, I agree. Since you were talking about EVs, I was thinking, in the last month we saw EV sales go, I think, shoot up to 12% in the last report that I saw. What say you about a number like that? I mean, obviously it's driven by, the tax incentives ending, but that's a whole lot of people out there that went and said, I'm buying an EV,
Yeah, and I think, though, when you look at that number versus the next month or subsequent months and smooth it out, it's, it may be 12, the expiration of the tax credits, but then if it's 4, right, when you average it out, it's going to be what it is. I don't think there's any secret, though, that it's going to be more difficult, without those tax credits. I'm not sure how much of a driver it was. I would hope that it wasn't everything, because now that it's gone, it's going to be a big drop off in volume. But look, you've seen it too, Jim. You've seen manufacturers talk about eliminating EV platforms and nameplates. Very short into the product cycle. Yeah. We're not talking about something that's 8, 10 model years. We're talking 1 or 2. And the automakers have backed off them. So I feel like the automakers the OEMs are seeing where the demand just isn't going to be there for a broad lineup of nameplates. Maybe a handful, one, two, you go forward. It becomes a compliance vehicle. You hit your corporate average fuel economy, your emissions goals, and then you go on and you sell typically internal combustion or what's making you money.
That's right. That's right. So this is also driving used car sales, needless to say. CarMax released their earnings recently, and what stood out to you on that? And of course, CarMax took a hit on their stock price and such, but I would have thought just the opposite. I would have thought because of used car sales being as strong as they are, but what's your take on that?
Yeah, so here's my logic on that, right, is that CarMax reports a difficult quarter. I think, right, this ties all the way back to the new vehicle market getting tighter, right? Mm-hmm. Difficult to pull consumers off the sidelines. So let's call the new vehicle market more difficult. What happens is as pricing and margin power go away from the full line dealers, they have the revenue flexibility to go into other segments, right? It's really 4 businesses under one roof.
Yeah.
So I think what's happening is that the used vehicle segment is cycling back into favor for those full line dealers from some of the miss on the new side.
Good point.
So what happens is now you have the CarMaxes and Carvanas competing harder for that inventory, and there goes some of the margin. So to your point, when you look at it, CarMax stock took a big hit. Yeah. And I think the initial reaction was that the other dealer groups in sympathy fell as well. And I was kind of looking at it and saying, I get it. The used vehicle market is going to be more difficult for everybody, but ultimately it's because of the other dealers, the full line dealers and publicly traded, that would be, AutoNation and Penske and Son, Lithia, Group 1 and Asbury. It's because of them that CarMax had a difficult quarter. Not that this means that everybody's going to have difficult quarters. I think it just there's more attraction to the used vehicle segment for those full line dealers because they're losing a little bit on the new vehicle side. So interesting to watch going forward. I mean, the CarMax stock, for the quarter is down, 30%, 30+%. None of the other dealer groups are. And I just think it signals increased competition in the used vehicle segment going forward now.
Yeah, for sure. What takeaways should dealers keep in mind from CarMax's performance for the rest of the year?
Yeah, so when you look at it, right, if you look at the revenue, which was down 6%, and 4% of that was, by my estimate, was volume, and 2% of it was pricing. So again, you have, as the new vehicle price pulls higher, so does the used. But it was really that 4% of it being volume in terms of the decline in revenue shows that there's more competition, that those other full line dealers, even not the publicly traded ones, but all the franchise dealers are kind of looking to the used vehicle space to make up. Maybe it is about affordability at those price points or just revenue generation and just kind of getting to better margins in another segment. So I think dealers, it's time for that pivot. We've been talking about it for a couple of quarters that, as pressure comes in on the new vehicle segment, what do? You go to your fixed ops, your parts counters, your service bays, your used vehicle lots, and that's where it's made up. And I think that's what's playing out right now.
Right. In terms of EVs, just to jump back on that for a second, what is your take on EVs as we go into 2026? Is it going to just settle way back down because of the taxes not being there? And of course, we've talked about the demand not being at the level that the OEMs thought it would be there. Where do EVs end up in the market in the year to come?
I mean, I think my initial take is exactly that, right? Is that without the subsidies, you would expect it to be a tighter market. But like I said, without that way forward, without that catalyst, I would not be surprised to see OEMs push a little bit harder, it's going to mean some financial difficulty. It's going to mean losses,
Yeah.
absorbing those losses. But like I always say, look, not every sale is a good sale. But I think it can have a purpose outside of profitability.
Yeah.
If profitability was the purpose of EV sales from, the past 10 years, it hasn't worked out that way.
Right.
I wouldn't be surprised to see a little bit of a volume push, sort of like what you would think with tariffs. The automakers say we can't push along these price hikes without new technology. We're going to absorb them. I could see more OEMs saying, look, we have the product, we've built the lines, we need to tweak maybe some of the technology, some of the capabilities, but we're going to push. It's going to mean some losses here, but we have to break through and get some scale, reduce some costs on this, get closer, because this is our way forward. So maybe it's not about profitability in 2026. Maybe it's about establishing the product as being reliable, as being, maybe it's not for everyone, right? It's a more of an urban runaround, that everything changes to say that we're marketing this with a different mindset in 2026, but we have to get it to work because we don't know what the next thing is. We've already made these investments, and you're not going to throw good money after bad forever.
Right.
But I feel like the purpose of the EV investment may change in 2026.
Yeah.
From the next leg higher and profitability to say, we don't need it to do that because we know it can't do that right now. We need it to do this. Get us in the door, show that the product is good, that it's reliable, total cost of ownership is actually reasonable. You can charge them. Here's the way to use them best, and that kind of thing.
Yeah.
So the marketing of it can change significantly in 26, only because I feel like it has to.
I know here in Atlanta, they're running ads for the Mach-E for $239 a month with like $3,900 down. It's a lease deal, but $239 a month. I mean, anything in the twos nowadays, and that's a heck of a car,
Yeah, no, and I've seen that, and people have come to me and said, you can't believe, and a lot of people have said to me, like, hey, you're going to be mad at me because I bought an EV, and I'm not anti-EV by any stretch, but the deals are just too good to turn down.
I know, they really are.
I've had a number of people give me that in the 200s number, and I'm saying, even if it's a 24-month lease, it's not costing you anything to own it.
I know, it's unbelievable.
And find anything less than $400, $500, $600 these days.
No question. Brand new with a warranty, and it's crazy. It's crazy.
As a commuter, as a grocery getter, maybe it works for people, and that's what 2026 becomes about. Is, hey, we're getting away from the six-figure EV and going to the affordable EV. Again, it's going to mean some financial hardship for the automakers because, if you're selling $30,000 EVs that cost you $50 to build, it's a problem over the long term. But you need to get people an introduction to the brand, to the product, to the technology, and hope that it can scale and costs come down, and then that the financial dynamics of it make a little bit more sense, hopefully.
Right. We haven't even begun to talk about, and it's a whole nother show, but the China or the Chinese coming in with their vehicles into the U.S., which could be the answer to affordability and EVs and quality and better technology. But that's a discussion for another day.
There was a real interesting interview with Jim Farley who talked about it, and I kind of been suspecting talking about this, and he talks about how far ahead Chinese automakers are on electrification, including Tesla.
Yeah.
And I think we see Tesla in the U.S. as the EV leader, and when you get outside, as I do, and talk to people in China or from Chinese manufacturers, and they're saying it's really not true. They're really getting left behind in terms of technology. And what's scary is not only in EVs but also in autonomous.
That's right.
They're saying that, like, the innovation in China, the workforce, the work ethic is just so far beyond that they're innovating every single day.
Yeah, it's incredible.
and even the best that we have, which we think is Tesla, can't keep up. So it's an interesting interview. I would recommend reading it.
Yeah, without a doubt. Kevin Tynan, Director of Research at the Presidio Group. Thank you so much for joining us on the show today. Very much appreciate it. It's always great catching up with you, and I know that our viewers and listeners get a lot out of your content, your time with us. So thanks so much.
No, it was my pleasure, Jim.
Great, thanks.